How much money do I need to start investing? This is a commonly asked question that we get. Look, you can start investing for as little as, $50,000 or $60,000. How do I secure finance for my next investment property? What type of investment property should I buy? What should I look for in an investment property? Welcome to Property Banter by Pinnacle Buyers Agents, powered by Hashtag. In this episode, we're going to discuss becoming a property investor and the most commonly asked questions that we receive. So let's get into it today. Hope you enjoy. How much money do I need to start investing? This is a commonly asked question that we get. Look, you can start investing for as little as, $50,000 or $60,000 even. The main thing is that you're not trying to outsave the market. Now, obviously in Australia right now, we are in a very high inflationary time, and we are noticing that, properties are going up super quick, and quite often, especially in the areas that we're buying, properties are going up faster than people can save money, can save their deposit. So, don't be afraid of using LMI and put down that 5%, 12%. 10% deposit, whatever it may be. Talk to your mortgage broker. I think the sooner you get in the market, pay the cost of doing business, which is how I see LMI, Lenders Mortgage Insurance. Get into the market as soon as you can, and especially if you use data to your advantage, you'll be able to buy in a good market that will go up in value and get you some equity to go and purchase your next property. So definitely for as little as $60K, you can get into the market. Don't sit there trying to save yourself $150,000 or $200,000 deposit. It actually goes against you a fair bit, because you want to be in the market as soon as possible and essentially letting the market do the work for you, because the market's going up in value in the areas we are investing. Question 2, how do I secure finance for my next investment property? Well, you need to speak to a broker. Rule 1, always speak to a broker. Don't go to your bank. The broker will talk to the bank for you, or the right lender, and find the right product for you. The mortgage broker is essentially a service that's paid for you, and they go and they're accredited with many different lenders, and they will go ahead and find you the best deal, the best interest rate, or the best product that actually suits your personal situation and your strategy. So definitely use a good mortgage broker. If you don't have one, get in touch with us. We've got plenty on our panel that we would be happy to share with you. Another thing that you need to be mindful of is the fact that everyone knows a broker. It's kind of like everyone knows a real estate agent, or everyone knows someone in some industry. That doesn't necessarily mean that they are the best, or they're experts in their field, or that they're any good at their job. I'm sure you go to work and you see many people at work that aren't good at their job, and they probably kill your life at work. You definitely want to be around good people, not just a mortgage broker. You want a property investment mortgage broker, and someone that's really, really good at their craft. So definitely reach out if you need that individual. We have we have access to them. Question 3, what type of investment property should I buy? Well, it's a very open-ended question. There's so many answers for that, but how do I answer this? You should be looking to buy an existing property, not something off the plan, and you should be looking at buying a property that suits your strategy and what you're looking to achieve. Everything is based on an end goal, and we reverse engineer the strategy to get you to your end goal. So, that might not necessarily be buying a house just down your street, or somewhere that or taking family's advice and all those sorts of things. You need to be buying in the right area with the right data set that suits your strategy. I mean, it might be a townhouse, it might be a house, it might be, interstate. There's a lot of factors there that come into play when making that decision. So definitely seek some help and make sure that your first one is done properly, because that first one either sets you up or stuffs you up, essentially, right? That's why the majority of Australians who invest in property, 95% of them only have 1 or 2. To be in the top 1%, you don't need a lot. You need 5 properties. And I know that sounds a little funny. You don't need a lot, but getting to 5 or 6 is super easy if you get number 1 right. So yeah, happy to chat more if anyone has any questions with regards to that. Question 4, what should I look for in an investment property? Well, I think data is very important. So once you analyze the data is going to direct you to an area that you need to be investing in, or that you can invest in. And the area that you live in might not necessarily be the right area and it might not have a great data set. So you want to be buying somewhere where the market is going to be going up in value or could already have started going up in value and is just turning into or on the cusp of turning into a hotspot. So it's very important that you use the data to pinpoint your area before you start on asset selection. You need to get the data set right. So yeah, and look for existing over brand new, and obviously something high yielding with as much land as possible. But yeah, definitely look at the data set first. That's the most important part. So how do we calculate return on investment? So now rental yield is what it is essentially. And this is what, when you hear people talking about, it's got a 5% rental yield or whatever, 6% rental yield, this is what they are talking about. So it's the annual rental income. So it's the annual rental income divided by the purchase price times 100, and that gives you your yield. So it could be, weekly rent of, $500 a week times 52 divided by the purchase price times 100. Question 6, how do I minimize risks in property investment? Well, there are so many risks in property investment, but obviously this is what separates the average investors from the great ones, and that is they understand how to minimize risk. They know how to take out good insurance policy that might not necessarily be an insurance policy from an insurance provider, but mitigate risks. So using a good buyer's agent or somebody who's achieved what you want to achieve. So me buying 14 properties in 12 months, that happened because I learned strategy from somebody else. I refined it and I did it my way, but I didn't invent the wheel, and there's plenty more before me that were property investors, and there's going to be plenty after me. So the same goes for yourself. Whatever your strategy is, you need to seek the right help from someone who understands and has achieved it. A lot of times we like to take opinions and advice from real estate agents because you feel that they're in the real estate industry. That's absolutely irrelevant. Most real estate agents I talk to have no idea on how to invest in property. So, just like listening to family, friends, your uncle at the barbecue. Everyone has an opinion, just like everyone would have an opinion on how you should do your job or how you should live your life. It's the same with property investment. Unless you've achieved it, unless they've achieved it, I wouldn't be taking their advice. So I think minimizing risk in that way is very important. But then when you meet these people, they are going to show you all the things that they do. They're going to show you how they get there, or who they use for pest and building, how they, use a separate insurer for, building, but a separate insurer for landlord insurance. All those little things that they do differently that are super detailed, you will learn from them. So don't try and go it alone. I think the best way to minimize risk is to be around people, like-minded people that have achieved what you want to achieve. That is the best way to minimize risk. Okay, question 7. Is it better to invest locally or investing in another city or state? Now, this is one, I even started my career like this. When I bought my first property, bought a second one all locally. I didn't go interstate, which at the time would have been amazing for me because I would have doubled my money if I had gone interstate and went to Brisbane, for example, when I was living in Sydney. There are other markets that are at different stages of their cycle. The thing that we do wrong as first-time, second-time investors is we buy where we feel comfortable. You need to get rid of that mindset of buying where you feel comfortable. You need to be buying based on where the data set tells you to be buying and where the value currently is. For example, Melbourne now with a $450,000 price point for houses, right? That's value for money. Now, if you're not from Melbourne and you don't necessarily want to go to Melbourne, but you should, because that's where the value is and that's where the data set points to. So if you're based in Sydney, you've got to be careful about, not buying in your backyard just for your own comfort's sake. You really need to shift your mindset and really look externally. We are all the good investors are all borderless investors. We go where the money is. We go where the market is, where the data says to go. So definitely, I think investing interstate is ideal. Also because some of the rental yields are a lot better than Sydney right now as well. So you need to really go where the market dictates. Okay, should I manage a rental property myself or get a property manager? Now, this is one that is a no-brainer. You should definitely not be managing the property yourself. You should have a qualified property manager, and you shouldn't skimp on your property management fees, guys. You really need to pay for someone who's out there that has that experience, that that really goes that extra mile. And when it comes to property management, I hear many investors talking about, saving some money. Is it 5.5%? That's better than 6.6%. I mean, in the scheme of things, it's a couple of dollars a week. And if you're making a $500,000 or $600,000 investment, a couple of dollars a week does not come into play. That's not where you should be skimping. You should be managing everything. You're in business, right? You're a property investor, but this is a business and you should be treating it as such. So making sure that you have a good property manager is key. And don't be afraid to switch property managers, because over time I've noticed that many property managers do get a lot on their books, and management teams change and so on and so on. So don't be afraid to find a better property manager if you do need one, but definitely pay for a good one. How do we handle maintenance and unexpected expenses? Now, as a property investor, you should have spare money in that account to account for a rainy day, just like you would, with your standard personal budget, right? You need to have some issues there, some money there to handle those issues when they come up. But I'll give you a little trick that I personally like to do, and that is when I buy a property, I like to get a handyman or a plumber out there to have a look at all the taps. I like to get everything done at once, just so I don't get staggered calls all the time. So let's say there's a leaking tap. Cool. Well, we'll have a handyman out there to fix a leaking tap, but I'll get them to look at all the taps in the property. Make sure everything is serviceable when we get our smoke alarms and we get all our compliance and stuff. So you want to make sure that you get your money's worth by having that, because you're already paying a call out fee to have that person on site to have a look at that leaking tap. You may as well get them to do a couple of other taps whilst they're there. That saves you getting a call out in another 12 months saying, hey, we've got a leaking tap over here. Can someone come out again? Then you've got to pay another $150 call out fee. So get it all done, get everything serviceable and sorted prior to getting the tenant in so that you don't have to do it later. Okay, exit strategy for property investments. Now, there's so much we can talk about on this topic. There's a lot of people that love to sell a property as soon as it goes up in value and they cash out. There's people who are all about that long-term gratification or delayed gratification. Where they're looking to, really see that compound effect of property and then pass that on to their kids in a trust. Whatever your strategy is, make sure you understand the tax implications and you talk to an accountant and you have a strategy. So whatever it may be, it all comes down to strategy and planning for that end goal. So if that end goal is, I really want $200,000 passive income and I want to build a portfolio, and I sit here with $100,000 today, well, let's engineer that, how we're going to actually get there over the course of the next few years. So it's super important to have that, and then you'll know, what your exit strategy is, because you will have some properties that you're going to keep. You'll have some burner properties. You will, you might be, once you sell the burner properties, you might be granny flating a couple of those. Whatever the strategy may be, you definitely need to get professional advice on that and have a good plan moving forward, because without a plan, what's the saying? Without a plan, planning to fail, or something like that. How can I find under market value properties? This is one that I get asked all the time. And as you know, we are very, very good at doing this. I've built my portfolio, my career on being the guy that does this. I am going to reveal the secret now. It's quite simple. It's who you know. The who you know is just as much relevant in real estate as it is in life. And anytime you hear someone say it's all about who you know, it's no different in real estate. So what you need to be doing is making contact with the people that find these deals. And that means picking up the phone, behaving like the way I do. Before I was a buyer's agent, I still behaved like an agent. I just didn't know it. So I was building that rapport. I was popping down to the real estate agency. I was having a chat with them, making sure they knew who I was, making sure they knew what I wanted, right? I wasn't being a pain in the ass. I was making sure that I was a likable character, because you don't want to go down there and be a pain in their ass, right? But you want them to know and think of you when something comes up. So the way I went about it was, I'd let the agent know, hey, when you've got something that's not marketable, something that may be messy, something that may have termites, something that, may have some sort of issues that prevents it from looking absolutely schmick on realestate.com, I said, give me a call, because I'll take care of that. I'll buy that property. I'll sort that out, and I'll be the go-to for when that pops up. So that's how I got my foot in the door. So if you're looking to do a bit of work, the paint, the flooring, all the way through to full renovations, if you're looking to do that, you fall into a certain category, chat to the agent, let them know. Chat to the agent and ask them for anything that's off market, anything that's a fire sale that they need to move quick. But you need to move quick as well. Make sure that you do what you say. Don't give them a headache. Real estate agents, the majority of them, I don't want to cop some slack for this, but there's a lot of them who don't give a fuck. It's very simple. They just want to do deals and they just want to move on. And, a lot of times these properties are offline and they just want to move them. Get to know the agents and you'll be right. So that's pretty much how it works. There are a few people who do wholesaling as well. And another one which is good is getting to know property management teams that don't have a sales department. So they could be a small property management team and they don't do sales, but eventually someone sells off their rent roll and they don't mind getting the rental back. You could come in and obviously let them know that you're an investor. You won't be moving the rental to your rental department and you're happy to rent through them. And a lot of times you'll get preferential treatment. There's a few little tricks there, a few little secrets for you. What are the best tools and resources when researching property? Now, obviously, realestate.com comes to mind first. Whilst we don't buy our best deals, we don't buy the under market value deals and the off market deals on realestate.com. It is great as a comparison platform. So you get to see what sort of properties are out there. And look, it serves its purpose. You check some comps, some comparables, and it gives you a good idea. But Price Finder is another one that we use, probably more so for comparables than realestate.com. And then the other one is Hashtag Analytics. Now, this is the one that excites me the most. This is an amazing platform. This is, in my opinion, the best data tool that we have as investors in Australia. They are innovating. Every couple of days, there's some sort of addition to this platform. If you are not on this platform, you need to get on it. I'm happy if you just message me. I've got a discount code for it. It is so detailed and literally picks your hotspots for you. Right? If you know how to input, you know how to use it, you can also jump in and join the mastermind where you learn. You don't even have to be a buyer's agent. You don't have to be a property expert. You could just want to learn data. And this platform and this amazing group can teach you how to invest or how to find hotspots, right? So super cool. Hashtag Analytics, jump on it if you haven't already. Should I be worried about interest rates when investing in property? Now, interest rates go up, they go down. They're like the stock market. They're like your bank balance, right? Some days you've got more, some days you've got less. It's a short-term thing and we shouldn't get... Humans, we are very short-minded, short-sighted is what I'm looking to say. We're very short-sighted and we only look at what's in front of us. And if rates are up 0.25, then, everyone's worried and stressed about it and so on. Now, whilst I understand that it can create mortgage stress, rising interest rate rises, we have to be mindful as investors that whatever we're getting into, whatever we're buying, that we can obviously afford to do it, but understand that it is a long-term game, property investment. Now, I clearly remember 8% interest rates in 2008, and I could have bought myself a house in Macquarie Fields in Sydney that was $250,000 on a 1,500 square meter block, which I could have put 6 townhouses on, right? That property would be amazing to own right now. But at some point, whoever held that through 2008, 2009, they did it tough as rates went up and they were struggling. So it's one of those things where it's part and parcel of the game and we just need to ride it through. But by the same token, you want to be buying high yielding properties as much as possible. You want your portfolio to work for you, not take money out of your week to week paycheck. You don't want to sacrifice your lifestyle for that property. So everyone out there, going and buying a $600 negative a week Sydney investment property, we definitely stay away from that as investors. If something is slightly negative, that's okay, as long as it turns to, from negative over to neutral at some stage, and, from 12 to 24 months, just a bit after that, that's acceptable. But you don't want to be buying a $600 a week negative property that won't see positive cash flow for the next 15 years. So be mindful of this when buying your investment property. And this is where expert help can definitely shed some light on what you should be doing and the right strategy. Okay, what's the process when inspecting an investment property? Now, knowing what to look for is very important. It's based on experience, right? So when you go through a property, when I go through a property now, I'll be able to tell just by looking at it if there's a part of it that's sinking, if it's had termite issues. I know where to look, how to look. I've been through so many building and pest inspections. It's not funny. I'm at the point now where my building and pest inspector asked me the other day about a property that I bought, and he's like, "Hey, what did you call me?" And I said to him, "Because I don't need you." I said, "I bought it that much under value and so on, that there was no point in literally calling you out, because I knew based on all the work I had to do that I was making a profit regardless of where it was." So, having that experience is all well and good. But when you start out, having a buyer's agent on your side to help obviously navigate this process with confidence is very important to ensure that you don't buy a lemon, you don't buy a property with some major issues, and they will have a team that they trust. Now, this is a very important point here. Do not take the pest and building inspector that your real estate agent recommends, or the real estate agent that you're buying through recommends, right? I've been through this before. There are some dodgy characters out there. They will lie on that report. They will say the wrong things on the phone to you, and they'll mislead you. So be super careful. The real estate agent who is advising you who to use, quite often they will be giving you someone that is very relaxed on their reports, because the selling agent wants to get the property through and get it sold. They don't really want someone super detailed who's going to come through and pick it all apart and do a 70-page report with a whole heap of photos and highlighting every issue. The agent doesn't want that. So quite often I will pick an inspector that might not be from that particular suburb. I'll pick one from a few suburbs over or wherever, or I'll jump onto a BNI website. Usually they will be more reputable. So I'll jump onto BNI and I'll find out who the inspector is that's in that group, and then I'll get them out there. But definitely want to have your own inspector. So I've got my own team that I use and I trust. That's because I know how detailed they are, and they don't miss a thing. It's absolutely amazing, the difference. And it's like, once again, as I discussed earlier, there's a huge difference between people that are, very average and very good at their job as they are in many different roles. So definitely having a good pest and building inspector is very, very important. Okay, how does inflation affect property values? Now, I think during COVID, we've all got a crash course, right, in how inflation works and how the printing of money has an impact on the property market. And it's done so historically as well, but we actually got to see it in real time in our own lives, right? Watching it right before our eyes go up in value. So as the government prints money, assets go up in value, and real estate's one of the best assets. I'm not a big stock market guy. As you can tell, I love real estate, and obviously using the power of leverage in real estate is super important. So over time, the property goes up in value. It's not so much that the property has gone up in value, it's that your dollar has less purchasing power. So yeah, when you see for example, a property that I bought once upon a time was $8,000. And it's not that it was $8,000. $8,000 was a lot of money at the time. But, with the dollar devaluing, the price of the property goes up. But in actual fact, it's your purchasing power that's been eroded, hence why property values are up. So look, it's a great way to hedge inflation. And, if you're putting down a 20% deposit on a property, it's way better than putting 100% of it in the stock market, having no leverage. I'd rather be in control of a real estate asset than the stock market anytime. How does inflation impact property values? Well, the government prints money. That's the simple answer. And what we have here is not so much that property goes up in value, it's that the dollar devalues as well. So, property prices we've seen during COVID, we've had a crash course in seeing it in real time, where we're in an inflationary environment. We're short on supply as well, but in an inflationary environment where the government's printed heaps of money and they're debasing the currency, and property prices have risen a great deal. And with real estate, what we love is we use it obviously to hedge inflation. And it's actually great because we can leverage. So you can put down a 10% deposit. Let's say we put down a $50,000 deposit, and we can be in charge or in control of a $500,000 property. So our $50,000 in charge of a $500,000 property and a 90% LVR. And if that property goes up 10% in value, we've literally made all of our deposit back in a cash on cash return, right? So it's essentially you're making money on the total asset value, not just on your cash amount that you've invested. Whereas let's say, if you wanted to put money in the stock market and you do put that $50,000 in the stock market and the stock market went up 10%, then that $50,000 portfolio would have gone up by $5,000. So there's a huge difference, and the power of leverage compounded into a large property portfolio over time is just a way better, faster way of making money than investing in the stock market. I know I keep shitting on the stock market. I just can't stand the stock market. I got burnt in 2007 and I'm very anti-stock market. I think that everyone has this view of the stock market where it's not corruptible, and because there's a Security and Exchanges Commission, and because they're publicly traded companies, that everything's done above board. But yet I just have a real distrust in the stock market in general. If you've watched The Big Short, you will know why. If you haven't watched The Big Short, go watch The Big Short and then come back to me in the comment section. Okay, what are the common mistakes to avoid when investing in property? Well, buying brand new is one of the biggest mistakes that I see people make. They get sold a dream by a salesman or a spruiker or their accountant even, or financial planner, where they're like, you know what, you need to save money on tax. Soon as someone pulls out that you need to save money on tax, or these are tax saving strategies, you know straight away that's not an investment strategy in property, in my opinion. That is inferior, and you're simply paying for the brand new sticker price for that property. So to give you an example of what I'm talking about, buying brand new, it's loaded with 30 to 50K in commission for the person that sells you that property. So they're selling you the brand new tax saving strategy, but they're pocketing 30 to 50K on the back end. You are the product. This is just like when you use Google or use social media, you're the product. That's why it's free, right? So they're selling you that. Whereas as a buyer's agent, we charge our fee up front. You know what our fee is? That's because it's for our time and our expertise. So it's very, very different. So stay away from the brand new stuff, because the person selling it has to make a margin. The person that's built it or developed it now, the builder, will want to see his 50K or whatever he wants to make as a margin on that home, right? Or on that development. So before you know it, you're buying a $700,000 property that's loaded with $80,000, $100,000 worth of comms or profit to somebody else. Whereas I'd rather go buy something that's 10 years old and it's already found its level in the market, and we might be a $600,000 property now, and then we go buy it for $550,000. I mean, that makes way more sense. It's kind of like not buying. It's like, okay, the Toyota Corolla brand new, whatever they are, let's say they're 30K brand new, you could buy one with 40,000 Ks. It's pretty much the exact same car. If it's been serviced, looked after, it's 3 years old, it's got 40,000 Ks on it, and you can buy it for $10,000 less, you'd always buy that car. It's the value for money. And this is what I stress all the time. Buying value for money never goes out of fashion. Hence why a lot of the real estate investments that we've bought, all the existing stock that's under replacement value, under market value, that's affordable, has performed really, really well over the course of these 14 or so interest rate rises that we've had since 2022. It's knowing what to buy. So stay away from brand new, buy value, and you should be okay. Should I invest in residential or commercial? Now, residential always to start out. If you're investing in commercial starting out, God bless your parents' trust fund. That is, you've done well. Being born into the right family will definitely get you far super quick. But for those of you who aren't inheriting any money and just want to start out investing and want to make money, you definitely need to be buying residential. You need to be using the power of leverage, because if you don't come from money, I don't come from money, and I use the power of leverage and paid more LMI than anyone I know, I think. And look, you definitely need to. You want to scale aggressively. You want to have that portfolio, so that portfolio is going up in value. So you want to scale a $2, $3, $5, $10 million property portfolio, and you need to do that with leverage, because you don't want to do the old WOG style where everyone pays cash for their house, then you own that cash outright, and then you might buy an investment property. By the time you do that, that's super inferior. That could be 15 years before you pay your first home off. And you need to be reinvesting, and you can scale $2, $3, $4, $5 million portfolio in just a few years. It's not that hard with the right strategy and obviously the right acquisitions in the right area with the right data set. So we need to be buying residential, and that's the best way to scale. Later on, when you've built that portfolio and you can make that switch, fantastic, and make sure you buy the right deal. Commercial has so much benefits in it, but when you're starting off, you definitely need to be into residential. Am I going to be able to find a tenant? So many investors are worried about, making sure they find a tenant for their property. They want to buy properties that have tenants in them already, just so that they have the tenant in place. It puts their mind at ease. Look, that was something that was incredibly beneficial many years ago. Right now, with the low vacancy rates, we have so many tenants out there looking for a property. Even if you buy a property, from a vendor that's moving out of that property and it's going to be empty, don't stress too much. As long as you're buying in the right areas with the right data set and a vacancy rate below 1%, you will be fine. Don't focus too much on that. Right now, we have a real shortage of supply. So it's not hard to find a tenant at all, but you should always safeguard yourself and make sure that you have that little amount of money in the bank account to cover a rainy day, and you need to allow in your budget a couple of weeks a year without a tenant, just in case a tenant moves out by the time you get another tenant and so on. So always make sure you have that contingency. Okay, cash flow versus capital growth properties, which is better? Now, this has been a topic in real estate for a long, long time, where you buy one or the other. The funny thing is, you can have both, and it's very, very interesting. So you do need a mix of both if you're looking to scale a portfolio. So unless you come from money and you're looking to scale a portfolio, you definitely need to have a balance there. So I love to purchase positive cash flow properties as much as possible. The last 2 years of interest rate rises have really, really, they've essentially made the positive cash flow property fairly scarce in Australia. Whereas back in the day, when I built my portfolio across Sydney and Brisbane, I averaged, I think, 7.5% yield over 10 years ago. So you could buy positive cash flow properties back then so much easier. Now you go to a lot of regional or rural areas and you can't buy positive cash flow there either. So it's quite an interesting environment, but that is going to change. We are going to see rates cut, and you are going to see a lot more cash flow and a lot more serviceability, and property prices will rise. But a lot of times where there is a low supply, there's high demand, the rental yield's good, property prices go up shortly thereafter. So you can have your cake and eat it too. What happens if I buy a property and it loses value? Well, this is an interesting one. So properties, if you buy at the peak of a cycle, they will correct and you will lose value. The goal is to not buy those. You need to be buying properties that are already at the bottom of their cycle, where there's nowhere for them to go but up. And you definitely, that would right now in November 2024, that would be Melbourne. So buying a house for $450,000 or $500,000, that property's got nowhere to go but up. That actually can't go back anymore in the current climate. So, buying properties in markets that are going to go up is key. Running to the hotspot market that you've heard about or everyone's been raving about for the last couple of years, that is already finished. The next market is the one you haven't heard about usually. So make sure that you're buying at the bottom of a cycle, not at the top of a cycle. If you don't know the difference, stop following the herd, talk to someone who knows. What is the better strategy? Flipping houses or buying and holding for the long term? This is one that we get asked all the time, and they suit this. Obviously, flipping houses suits certain types of people. Not everyone has the time and wants to spend their weekends, renovating properties, because I tell you what, it takes a lot of time, a lot of sleepless nights and headaches, and it will definitely stress you out if you're super busy. Obviously, a lot of people work big hours. You've got families, you got things you want to do, and the last thing you want to be doing is renovating. So, look, if you can make money flipping houses because you're in the game, you understand it, you know it, you need to get super educated on it if you're not. But you can make some fantastic money, and you can make your equity quick, right? And this sets up your property portfolio, but you can also lose money. One of the biggest things I see is people overcapitalizing and not understanding who their target market is at the end of that renovation, and they're not renovating it to who they need to, sell to, right? So a lot of education around it. So don't just jump into it if you are not experienced or not a trades and can get it done for cost price, right? But look, buying and holding is the superior strategy in the sense that you can buy properties, they can go up in value, and you can extract the equity to buy the next one, and then those two go up in value, and you extract the equity and buy the third one, and so on until you have, a 5 properties at $500,000, and you got a $2.5 million portfolio, and over the course of the next 7 to 10 years, that $2.5 million portfolio, if you do nothing with it, will just double to a $5 million portfolio. So if you're 30 years old now, you by the time you retire, you'll have a $30 million, $25 million portfolio, and you've started off, with just 1, into 2, into 3, into 4. So you don't have to do the extra work. You don't have to sacrifice lifestyle and work hard. If you want to fast track that, you could definitely do that by flipping, but be also wary of the costs involved with flipping, because the ATO is going to want their chunk. Real estate agents, entry and exit costs and holding costs and so on can eat into your margin. So make sure you get educated on that. But buying and holding is great. I'll tell you what though, if you want to flip houses, flip your principal place of residence. So if you want to set up a portfolio of 5 properties or 10 properties or whatever you want, that's great. Have your long-term buy and hold properties, but flip your principal place of residence every few years and get everything, and do a lot of it yourself. And every 3 years you renovate something, market goes up, you sell it, it's tax-free dollars, right? It's your principal place of residence, it's tax-free, and you can do the work there while you're living there. If you want to live in a construction zone, but you can make that money tax-free, and then just trade up. So every time you make profit, you just buy yourself a better house, or a house West house in the best street, but upgrade your area, right? Go to a better school zone for the kids as the kids start getting older, or whatever it may be. So yeah, you could do that alongside having the long-term buy and hold portfolio on the side as well. How can I cost effectively improve the value of my property? Now, paint and flooring, they're the two best, bar none. They're very simple, clean upgrades, right? And if you do them at the right price, they can be done, well, obviously cheaply, right? So you can, not knocking the painters out there. Obviously, there'll be a difference in your work to a quality painter, but painting is probably a more of an easier trade to do. Like, I don't want you, rewiring a house, right? We're not electricians, but you can kind of pick up a paintbrush or a roller and paint a whole house. I watch some YouTube tutorials. If you stuff it up, just go over it again. But that is a great cost-effective way to brighten the place up, freshen it up and get the flooring done. It's just, you could just be replacing the carpets or a hybrid vinyl floor or whatever you want to do. Make sure it's cheap, right? If it's in an investment property, you want to make sure you're getting your return. So make sure it's all cost price. And yeah, just as long as the property looks fresh, I think they're the best bang for buck. Kitchens are another one. When I started my portfolio, I was getting kitchens done. Okay, so I'll give you a trick now. When you're looking for someone to do your kitchen, do not go to the fancy company that is in, or back then it was the Yellow Pages, right? Or the company that comes up first on Google. They have a great marketing team. They have a great website. They have overheads. The way I did it was I found the guy who would make the kitchen carcasses for the large, big name kitchen companies and builders in the area. So this was the subcontractor that would just make them on scale. And I had him come out and he would remove the kitchen I had, measure it out, custom make the kitchen and install it for $2,750. This is 10 years ago. This is good old Rabar. If Rabar's listening, hey Rabar, hope you're doing well, brother. But he was great, and that was $2,750 for a 10-meter white on white polyurethane kitchen, Chinese soft close drawers and Bloom soft close hinges on the doors. Yeah. And then we just used a laminate bench top. Obviously no stone for $2,700, right? Stone costs way more than that alone. But, we kept it cheap. And this was what I did for the investment properties, right? Funny thing is I did a similar spec for even for my own house. I think it was like $5,000, just a little bit better, but it's doing it all cost effectively. Today, we're doing kitchens for around the $8,000 mark. Same thing with bathrooms, should be, $5,000 to $10,000 for a bathroom as well. Bathrooms, I can't stand doing anyway. I don't want to talk about bathrooms. That's a bit of a sore point, but yeah, they're more of a pain in the ass. But that all comes down to having good tradespeople as well. Okay, what resources are available for learning about property investment? Now, when I started my journey, I read the Steve McKnight book, 0 to 135 Properties in 12 months, I think it was, or in 24 months. That was an amazing book, as well as Rich Dad, Poor Dad. It really gave me a different understanding of money, different to how, I was raised, because I'm not much of a saver. I'm a spender. I'm just someone who's very good at making money, but I'm definitely not a saver. So just like the majority of people out there who like to spend money, this book will teach you about mindset and how you need to look at money in a different way. And then for strategy, if you want to exit these things, obviously like and subscribe to our podcast. That's number one, right? Watch us on YouTube, Spotify, and so on. But that Steve McKnight book gave me my start and taught me so much about the strategies that he did. And obviously he did that in the 90s, slightly different time. I did mine in the 2010s. But the principles of how to invest and the strategies that you should use, you can still adopt them till today. Buying something under market value, not paying retail for something, right? Getting a deal, getting something on sale, that's never going to get out of fashion. Until capitalism is gone, that's not going to get out of fashion. So all those sorts of things that you could, those books will teach is amazing. So, and of course, like I said, like and subscribe to our podcast, watch our content, check us out on socials. Really appreciate your time today. Hope you've learned plenty from today's episode. Thank you so much for tuning in to Property Banter.